What is an ETF, and how does it let you buy a small piece of the entire stock market? You probably heard of ETFs, or exchange-traded funds, but maybe you're not entirely sure how they work. Essentially, an ETF is a basket of securities that tracks a specific index, like the S&P 500. Think of it like a box that holds a little bit of many different stocks, all wrapped up together. When you buy a share of an ETF, you're buying a tiny piece of that entire box, which gives you a small stake in all of the stocks inside. This allows you to diversify your portfolio and own a slice of the whole market, rather than trying to pick individual winners. And here's the surprising part. Because ETFs are traded on an exchange, just like individual stocks, you can buy and sell them throughout the day, giving you a level of flexibility that traditional mutual funds can't match. So, how does this all work behind the scenes? Let's take a closer look. Vocabulary: securities, index, diversify, portfolio. What happens when an ETF is actually created? And how does it end up being traded on an exchange like a regular stock? Let's break it down step by step. Imagine you're putting together a recipe for your favorite dish. You need a specific set of ingredients in specific proportions. In the world of ETFs, this recipe is called a basket, and it's a group of securities like stocks or bonds that are assembled by an ETF provider. The surprising part is that this basket isn't just a theoretical collection of securities. It's an actual portfolio that's exchanged for something called ETF shares. Here's how it works. The ETF provider gathers the securities that make up the basket and then gives them to a special type of investor, known as an authorized participant. In return, the authorized participant gives the ETF provider a block of ETF shares, which are essentially a claim on the underlying basket of securities. And here's the part most people don't know. These ETF shares are then listed on an exchange, like the New York Stock Exchange, where they can be bought and sold by individual investors, just like individual stocks. This process allows ETFs to be traded throughout the day, with their prices reflecting the changing values of the underlying securities in the basket. So, to recap, the creation of an ETF involves assembling a basket of securities, exchanging it for ETF shares, and then listing those shares on an exchange. And that's what allows us to trade ETFs like we do individual stocks. Now that we understand how ETFs are created, let's dive deeper into how they're traded and what that means for investors. Subscribe for the next part of our explanation. Vocabulaire: sécurité, basket, autorised, participant, exchanged. What happens when an ETF needs to add or remove shares from a market? And how do the underlying securities actually get exchanged for those shares? This is where authorized participants, or APs, come into play. They're the key players in the ETF ecosystem. Imagine APs as the referees in the ETF game, ensuring that the number of shares in circulation is always balanced with the underlying assets. These APs are typically large financial institutions, like banks or investment firms, that have a special agreement with the ETF provider. Here's the surprising part. APs are the only ones allowed to create or redeem ETF shares, and they do this by exchanging the underlying securities for ETF shares. For example, if an AP wants to create new shares of an ETF that tracks the S&P 500, they would first gather the individual stocks that make up the index, like Apple or Microsoft, and then exchange those stocks for the ETF shares. This mechanism helps maintain the ETF's net asset value, which is the total value of the underlying assets divided by the number of outstanding shares. And here's the important part. This process helps keep the ETF's price in line with the value of its underlying assets, which is essential for maintaining the integrity of the ETF. By understanding the role of APs, we can see how the ETF ecosystem relies on these key players to function smoothly. What happens when the price of an ETF starts to stray from the value of the assets it's tracking? Can the system correct itself, or do we see persistent deviations? Let's dive into this. When the price of an ETF deviates from its net asset value, it creates an opportunity for authorized participants, or APs, to step in and profit from the difference. Here's how it works. If the ETF is trading at a discount to its net asset value, the AP can buy the ETF, simultaneously selling the underlying securities, and then redeem the ETF for those same securities, pocketing the difference as profit. And here's the surprising part. This process isn't just about making a quick buck. It's actually what keeps the ETF's price in line with its underlying value. This mechanism is known as arbitrage, and it's the key to ensuring that the price of the ETF reflects the true value of the assets it holds. By buying and selling the ETF and its underlying securities, APs help to eliminate any price discrepancies, which in turn helps to maintain the integrity of the market. So, in essence, arbitrage is the market's self-correcting mechanism, and it plays a crucial role in price discovery, the process of determining the true value of a security. And that's what helps to keep the ETF market efficient and transparent. Now, let's take a closer look at how this process affects the overall market dynamics. Vocabulary: arbitrage, net asset value, authorized participants, price discovery. What are the real benefits and risks of investing in ETFs? And how can they impact our portfolios? To understand this, let's break it down step by step. On the benefits side, ETFs offer a unique combination of diversification, flexibility, and transparency. Think of it like a pizza with many different toppings. By investing in an ETF, you're essentially getting a slice of the entire market or sector, which can help spread out your risk. And here's the surprising part. Because ETFs are traded on an exchange, you can buy and sell them throughout the day, giving you a level of flexibility that's not always available with mutual funds. But just like any investment, ETFs come with their own set of risks. For example, there are fees associated with buying and selling ETFs, such as management fees and trading commissions. And then there are the market risks. If the underlying assets in the ETF decline in value, the ETF itself will also decline. Additionally, there's the risk of liquidity. If you're trying to sell an ETF and there aren't enough buyers, you might not get the price you want. So, while ETFs can be a valuable tool for investors, it's crucial to understand these benefits and risks before making a decision. By doing your research and considering your own financial goals, you can make informed choices about whether an ETF is right for you. Want to learn more about how to navigate the world of ETFs and make the most of your investments? Vocabulary: diversification, flexibility, transparency, management fees, liquidity risks. So, how does an ETF actually work? Let's summarize. When you buy an ETF, you're essentially buying a small piece of a basket of securities, which can include stocks, bonds, or commodities. This basket is created and traded on an exchange, just like individual stocks, but with the help of authorized participants, who play a crucial role in keeping the ETF's price in line with the underlying securities. And here's the surprising part. These authorized participants can create or redeem ETF shares by exchanging them for the underlying securities, which helps maintain the ETF's liquidity and efficiency. Now, we've discussed the benefits of ETFs, such as diversification, flexibility, and transparency, but we've also touched on the potential risks, like market volatility and tracking errors. Understanding how an ETF works is key to making informed investment decisions, and it's essential to consider these factors before adding an ETF to your portfolio. By grasping the underlying mechanisms and potential risks, you'll be better equipped to navigate the world of ETFs and make more informed choices. If you want to learn more about how the markets work and stay ahead of the curve, be sure to subscribe to our channel for more educational content, where we break down complex topics in a plain English. Vocabulary: liquidity, transparency, diversification, volatility.